In the last few days and weeks, the stock market has taken an absolute beating. I know this can be a very stressful and concerning time, and a lot of people are wondering, what does this mean for markets moving forward? It's at times like these when emotions are running high that the biggest mistakes are made. I have no idea where the market's going to be in the next few days or weeks, and you should be very aware of anyone that says they do. But what we can do is look back at historical data to help give us some perspective. This won't just be relevant for now, as it's inevitable we'll see market crashes in the future. So what can we learn from history? First, let's zoom out to get some perspective. Now, this is looking at the FTSE All-World Index, and what we can compare this to is the previous crashes. There's two key things I wanted to pick out with this graph. The first is comparing this to previous crashes, so looking specifically at 2022, 2020, and 2008. You can see how dramatic of a fall these crashes were, but also how much the market recovered in those years to come. I think it's all too easy to get bogged down in the day-to-day, looking into the next few weeks, even the next few months. But really, if you're ever in doubt, zoom out to give yourself a bigger picture. Because what might seem like doom and gloom now, when we zoom out, it actually makes it seem so small on a bigger graph. The other thing I wanted to point out with this graph is just comparing between currencies. So this graph we're looking at now is in the US dollar. If we switch this to be denominated in GBP, you can see how much it smooths out some of those falls. That's because at some of these falls, the pound against the dollar has actually been falling. It smoothed out some of that dramatic fall. So if you were holding that index in the British pound, you would have been saved some of that fall. Now, you're not always going to have that benefit, but it was just important to highlight. If we look at average returns for the stock market, it's usually around 9 to 10%. But what you'll see is there's very few years where it actually hits that average. We can see wild swings. And even within that, if you look at a year where it's positive, say you have a year where it is that 10%, because it's just looking at individual years, what it doesn't take into account is the swings within that year. We could have swings of up to 40% where the market could have come down 20%, it could have recovered, and then we end up being back up into positive territory. And what I wanted to highlight with that is that although we can look at those average returns and just think, oh, if we hold for long enough, what we've got to take into account is the psychological element of holding throughout that time, going through a period like this. Because say, for example, and this is just using this as an example, if the market does recover and towards the end of the year, it ends up back being in positive territory. If you then to look back at this year a few years later, it would just appear like this was any other year and it was just another positive year. But when we actually look at the minute detail of what actually happened within that year, we would have seen a massive swing. So when you zoom out and look at some of these market crashes, and it seems like they are quite a few years spaced apart, some of that volatility is actually hidden within the data. This graph also highlights how common these drawdowns are. So this is looking at the S&P 500 over the last 95 years. This says that 94% of those years have had a drawdown of 5% or worse. 26% of those years have had a drawdown of 20% or worse. But what makes this time feel so different is the cause. It's that uncertainty which markets hate. We don't know what Trump is going to say one day to the next. This crash is being dictated by one man, which is extreme, but it also means on the counter to that it can easily swing the other way. It's important to know that all the previous crashes all felt different. They all had a slightly different narrative. They all felt like they were new, and it felt like it was going to be different from the previous times. But they all recovered back to new all-time highs. It's also important to recognize that the media and recency bias will make it seem like this is way worse than we've ever experienced before. Although the catalyst is different, the market has taken hits like this and still recovered to deliver great long-term results. But no matter how experienced an investor you are and however much you look at historical data, there will be some part of us that always feels like this is not a good time to invest. We'd prefer to wait for things to clear up and wait for good news before getting involved. And this is where the risk of sitting on the sidelines comes in and how this can affect your returns in the long run. If we look at annualized returns for the S&P 500 over the last 20 years, what this table shows here is that if you were fully invested throughout that period, you'd be looking at an annualized return of around 10.5%. However, if you would have switched your investments and held some cash and you end up missing the 10 best trading days, your annualized return would drop down to 6.2%. It would drop to 3.6% if you missed the 20 best days, and it would be just 1.4% if you missed the 30 best days. So this highlights how much of a difference it can make. Holding cash through these periods can make to your long-term results. The counter to that is that you're also going to avoid the worst days. But the problem with this is that you're trying to time the market, which is essentially gambling. You have to pick a point where you're going to get back into the market. In a crash, that's like trying to catch a falling knife. And if you're getting out of the market to then get back in, it's like trying to catch a falling knife twice. This is a very risky strategy, and most likely you'll end up losing money in the long run. Getting out is the easy part. If you're in profits, you can take some profit off the table. It's getting back in which is the hard part. If you look at all of the previous bottoms, they've never been obvious. They've always come out of the blue. And what usually ends up happening is that once the bottom is in, the market starts to recover. There's then good news. The media starts to pick up on it. There's then a bit more of a feel-good factor. Then people start to get back into the market. But of course, they're getting back in as the market's already started to recover. So they're getting back in at more expensive prices. This data looks at the performance of cash versus a classic 60% equity, 40% bond portfolio. This is looking at the last 35 years on an all-world index. So this says if you have 3 months in cash, you have a 61% probability of underperforming that portfolio with a median underperformance of minus 1.6%. If you have 6 months in cash, that's a 72% probability with an underperformance of 5.5%. And if you have 12 months in cash, there's a 79% chance of underperforming that portfolio with an underperformance of minus 9.1%. So I think it's clear looking at the data, if we have a long-term approach, the risk of holding cash. And I think our left side of our brain understands that data-driven approach. But it's the right side of our brain, the emotional side, the one that makes us make those decisions. That's what makes us fearful. It's strange, isn't it? The stock market is the only thing that, as it gets more expensive, we want to buy more of it. And as it falls in price, we want nothing to do with it. Most people think the biggest challenge is choosing what to invest in, but that's actually the easy part. The hardest part is actually managing your emotions and not over trading. It's being too active in the markets that lets most people down. This is where the simplicity and the automation of having a long-term global approach comes in. You're not having to actively pick a market that you think is going to outperform. You're simply betting that the world is going to keep on turning and the human race is going to overcome adversity just like it has done over the course of history. Automate your investing as much as you can. So set up regular investments by direct debit and then don't touch it. The more you can reduce the number of decisions you have to make, the better your overall return is going to be. I think it's well known now that most active fund managers don't beat the market over the long run. So first of all, what makes you think that you could beat the market over a professional? But also when you look at individual returns for investors in those active funds, they're even lower than the funds themselves because people are not only getting into active funds, they're also trying to time the market as well. So they're also getting in and out at the wrong time. So my advice would be, if in doubt, zoom out. And hopefully that gives you some perspective and some confidence. And try not to get caught up with too much of the hysteria with the media. I hope you found that useful. You can check out my recommended investment platforms down below. Thanks for watching, guys, and I will catch you in the next one.